Happy New Year! We hope you're all off to a great start. 2021 marked another strong year for the economy and for the markets. However, we're starting to hear more questions from you all like, are the markets overvalued? Can they continue to go up? Should we be worried about inflation? Should we be worried about the Fed and rising interest rates? Today, our team would like to address some of these great questions and hopefully ease some of your concerns. We're now in year 3 of this economic recovery and fully expect returns to be more muted and for volatility to pick up. As we move away from historic levels of fiscal and monetary stimulus, traditional drivers of economic growth will have to take over. Drivers like consumer spending, business investment, and inventory rebuilds. Led by a very strong consumer, we think these areas are still in very good shape, and that above-trend economic growth should continue to support solid earnings growth this year.
Inflation started to become a hot topic back in spring of last year. At that time, it was largely believed to be transitory, but with the supply chain issues from logistical challenges and from labor shortages, combined together with the unprecedented demand, has led to a surge in inflation, and now we're seeing the highest levels in 30 years. However, we are starting to see the supply chain issues ease at the ports, and companies are starting to catch up on their orders again. With less stimulus and the Fed expected to tighten this year, we could start to see inflation start to move towards the Fed's long-term target of 2%.
All eyes will be on the Federal Reserve and interest rates this year. The Fed's two mandates are maximize employment and stable prices or inflation. With the current employment conditions being very healthy, the Fed has turned its attention to inflation. It will be a delicate balancing act moving forward. If interest rates are raised too quickly, it could cause economic growth to slow down and risk a recession. But if rates are not raised quickly enough and inflation continues to grind higher, they'll have to aggressively increase rates in order to bring inflation down, which would risk a recession as well. We think the Federal Reserve will increase short-term interest rates by the middle of the year, with 2 to 3 hikes likely, maybe even 4.
Our year-end target for the S&P 500 is 5,053. However, it'll be anything but a straight line in getting there. Historically, we can expect a 10% pullback every 222 trading days or so. It's been over 450 trading days since we've had a pullback of that magnitude. So the volatility that we're experiencing now and will likely get through the remainder of this year is very, very normal. It'll be extremely important this year to not get complacent and to maintain composure. We're reaching out to you all now and in the coming weeks to discuss your individual portfolios and financial plans. But please don't hesitate to reach out to us in the meantime if you have any other questions. As always, thank you for your trust in us. We're wishing you all a fantastic and an amazing 2022.